Welcome to Shareholders of a Better World, brought to you by TBLI Group. At TBLI Group, we have an established reputation as an organization dedicated to building the ecosystem of global sustainability and impact investing. We're doing this through educating, advising, and facilitating transactions in global sustainability and impact business, as well as capital solutions for private companies, family offices, and fund groups. For nearly 25 years, TBLI Group has created a vertically integrated ecosystem of education to action through TBLI conferences and TBLI consulting. More about our company can be found at tbligroup.com. This webinar is brought to you by TBLI Foundation, which hosts educational learning experiences dedicated to a better planet. Through the foundation, we build sustainable communities by sharing the people and the experiences making a difference to so many of our lives around the world. Our weekly podcasts bring impact thought leaders that are doing and not only chatting. Now let me introduce my guest today.
Good afternoon from our studio in Amsterdam. I'm incredibly thrilled to have a very dear friend joining us, and I would say the godmother of ESG from the United States, Amy Domini. Before I introduce her, let me just give you some housekeeping information. If you have a comment or a question, just type it in the lower right-hand corner. There are 3 emojis, one for clapping. If you find something funny or brilliant, you can click on that. And if you move your mouse over a person's name, you'll be able to send them private, direct messages. After this 1-hour talk, we will go into the mixer or the virtual happy hour. I've added a link at the lower right-hand corner. If you forget, just exit and then go into the event preview and then click on that happy hour. So we're really, really lucky. I mean, I've known Amy a very long time. She was actually one of the first speakers that we ever had when we did our event, and actually the only person who ever organized a dinner for my wife and my mother at her home, which was fantastic in Massachusetts. So, Amy, thank you so much for coming. For those of you who live on a different planet and are not familiar with you, why don't you share a little bit of your journey from not doing SRI at the time to doing that, and where you think the future will be for ESG?
Well, thanks, Robert. And first, I do want to thank you for inviting me on. Robert and I go way, way back, and it's always been a thrill to watch what TBLI has become. It's such a contribution to the world that you've created here. But I also, before I start, want to just take a moment to discuss vocabulary. We've got the ESG, the SRI, the impact, the ethical, the responsible, and I'm just not going to go there. I refuse to try to suss out supposed differences between the various vocabulary words. To me, they're all identical. Here's what I believe. What I believe is that we all want ecological sustainability. We want the planet to exist. We all want universal human dignity. We want life to be worth living. Those are common goals. Now, do we believe that investors, which control such massive resources globally, have a role to play in providing this future of a surviving planet that's worth living on? If you answer yes to that question, come with me. That's my field. That's what we're talking about here. So it is my feeling that to achieve universal human dignity and ecological sustainability, investors must be engaged as key advocates. But I didn't always believe that. I came a long path, and I'll start sharing with it. For me, it began in roughly 1975 when I got a job. I know, it's hard. I hate it. But I became a registered representative of the New York Stock Exchange and NASDAQ with a brokerage firm called Tucker Anthony and R.L. Day. And in those days, there were stockbrokers who called up clients and said, here's a good stock to buy. And that was my job. What began to happen to me was that I had a recognition that this was a tough thing to do, that I didn't have enough people to call up, and I needed to build a reputation and become known. So I started attending night classes on how to be a good investor at the local MBA program and offering an adult ed class on how to be a good investor the next day, so that people would think that I was a good investor and would come turn to me for ideas. So I'd go to class, write it all down. The next day I'd teach a class and give it all to the public. As my business grew, I started discovering that there was one way that you could really turn off a client, and that was to tell them what a great opportunity there was in a company that they hated. And it's so difficult to attract and retain clients. I certainly didn't want to be making them mad with my investment suggestions. So I started asking an intake question. We're all supposed to know our customers, and we're all supposed to find out things about their financial picture. And in that process, I asked, is there something that you would draw the line at that you just don't want to hear about an opportunity? And it was amazing. People would stop, they'd think about it, and they said, well, I guess yes. And they'd come up with, and I thought to myself, holy cow, I've been blind to this huge demand out there. I've got to go out and learn something. Well, as I've said, it was the late 70s and prior to the internet. So in those days, you could write a snail mail letter to a university that had a computer and put keywords into it, and that university would feed it through the computer and find articles that might be of interest to you. These were just the titles of the articles, not the entire article. Then you could go to the library and you could pull those articles. So I put in words like stocks, bonds, ethics, responsibility, corporations, and I got back articles on mother-child bonding and the ethics thereof and things. One article came up. It was on Pax World Fund, which had launched in 1971 and didn't buy weapons. And I thought, holy cow, they're there. You know, I got to find out about this. I called them up and learned everything I could about it. And then I started to alter my class that I had been teaching. And I thought, you know, this is more interesting to people than just how to find a stock they want to buy. So I altered the class and I called it Ethical Investing. The catalog came out and two things happened. The class filled up right away, and a publisher called me and asked me, did I want to write a book? So certainly I wanted to write a book. I knew nothing about the subject, but I was eager to learn. So we launched this initiative to write a book and name it Ethical Investing. And the book took quite a long time. In those days, after the writing was done, it was 2 years to get it actually on the bookshelf. But in 1984, it was published. Now, the backdrop to this is in 1971, the presiding bishop of the Episcopal Church in America had traveled to the annual meeting of General Motors and asked them to stop operating in South Africa. In 1977, the Sullivan Principles, which were a code of conduct, actually sort of set of promises that companies would report on behavior in South Africa, had been codified. And there was an increasing interest in whether or not it was moral to be invested in American companies doing business in South Africa. Every library board, every school board, every foundation board wanted to discuss whether or not it was moral to be invested in South Africa. There was nothing out there but my book. So I became the person that went to every board meeting and talked about whether or not you could integrate ethics into the investment decision-making process, whether or not there would be any impact beyond feeling good by making a decision to divest of American corporations doing business in South Africa. In 1986, there was a crescendo of divestment, $600 billion divested of American corporations, and it became the headlines. In the United States, we didn't read about the slaughters going on in Cambodia, Nicaragua, around the world. We read about some kid on a bicycle in South Africa who had, been barred from getting to the school building. It became the story that dominated American news and much of the world news for years, which led to important other things. It led to, very importantly, sports teams refusing to play sports in South Africa. Also, a broad-based refusal to purchase from companies doing business there. By the end of that whole dynamic and the boat finally being delivered to South Africa, I had become a believer that investors had an important role to play. They were able to be the backbone of a movement that brought about a vote for 25 million people with virtually no violence in the world that we've come to see. So an extremely strong motion in that direction. It also led me to reach out to other people, because I was attempting to actually learn what this field was and write a book about it. So some early pioneers, Joan Bavaria had started what was then Franklin Research and Development. Robert Zevin, very active in the field. Wayne Silby, founder of Calvert, active in the field. But also people slightly related. Chuck Mathai talking about community lending, and Tim Smith, who had been running the Interfaith Center on Corporate Responsibility and primarily responsible for engaging in dialogue over apartheid in South Africa. We all came together with an idea that we had something in common and that we would be stronger as a group than in our little worlds. And that grew into what was at the time called the Social Investment Forum and has become the Forum for Sustainable and Responsible Investment. That was a self-fulfilling prophecy. It began to carry on. I want to back up to some of the lessons I learned from the South Africa, because it really shaped everything that I did from that point on. One thing was this debate largely began because the church in South Africa is part of the Anglican Communion. Sun never set on the British Empire, never set on the Anglican Communion, and the presiding bishop of the South African Church came to the Anglican once every 4-year event at Canterbury, talked about what was going on in his country, and asked for help. The head of the Episcopal Church heard that, went back and asked what could be done. There had been notice of a gadfly, Ralph Nader, who was bothering General Motors because they were the largest manufacturer in America. And it was, in fact, General Motors that was the largest employer in South Africa. And the Episcopal Church thought, well, we'll bother General Motors too. We'll ask them to stop doing business in South Africa. That's an important message for this industry. There is somebody on the ground who sees the problem. They're part of an international network. There's somebody across the ocean that has some power and some capacity and takes action. That network, that fiber, the importance of a global initiative was not lost on me. The second thing that I learned about that was these principles were extremely simple. How many blacks supervise how many whites and coloreds? Do you share the same eating facility? Yes, no, questions or numerical answers. You couldn't fudge the answer. It was a very clear cut. You did it or you didn't. It was a number. And because of those numbers, we had proof by the end of the decade that American corporations were aiding and abetting in this tightening of the system of apartheid. They were not part of the solution. And because we had proof of that, civil society had knowledge, and civil society started acting. And because of that, change came about in South Africa. So the importance of data to underlie every decision that's made was not lost on me and became something of core importance. The third thing was that as I went to board meeting after board meeting, and anybody who does public service speaking probably has their list that they know will be asked. And the questions that were asked all boiled down to three basic things. One, how expensive was it? Was it going to cost money? Was it going to anything that limits your investment universe must limit your return? You know, this was modern portfolio theory, and if it did that, then was it even legal? You know, so that was one whole package. Then it's really complex. You can't. There's no such thing as a clean company. You know, I don't care at all if people drink. Why should you care if people drink? You know, who are you to decide whether drinking's a good thing or a bad thing? Things like that. So it was a complex research process that didn't seem to have clear-cut answers. And that's one whole thing. And then there was, it's the wrong way. It's an ineffective way. Make money the old-fashioned way and then give it away if you want to give it away. Government's got a role in all of this. Where's government in your solution going on? So these three things were the challenges that existed out there. And so KLD Research and Analytics was born. Peter Kinder, Steve Leidenberg, and I started a firm to remove the barriers to responsible investing, these three barriers, and to generate enthusiasm for the field. And our idea was that, one, we would have to find out how much it cost. We would have to create an index of our own and come up with the answer. We didn't know that it would be good or bad, but we had to have an answer to that question, what it would cost. It did not seem logical to me or to my partners that avoiding trouble would have a cost. Generally speaking, investors' single biggest problem is what blows up in their face that they didn't expect. But, you know, aside from that gut feeling, there was no outcome that was foretold. We named it the Domini 400 Social Index. It's now a product of Minsky and not particularly similar to what it was at that time, but it did fulfill an extremely important purpose in that for the first 10 years while it was still at KLD, it outperformed broad market averages by a statistically significant amount. And the question as to what it would cost became the question of whether or not this was an advantage you could ignore. Very helpful to the industry and the field. We sold research. We standardized, based on the Sullivan principles, a series of questions. We looked at the stakeholders, who benefits from the company. We added to the traditional stakeholders, the natural environment, and a different kind of community. Instead of the hometown, we talked about the global community. We had suppliers, we had the employment base, we had the customers, and we had the investors in that package and we looked for data that was, one, ascertainable, preferably without the company's help. So as not reliant on some special survey of our own, but publicly documented information. Two, it had to be something you could count or answer with a yes or no, just as the Sullivan principles had been. No interest in an essay about the topic. We want to hear yes or no. And 3, it had to be significant. And people ask what that means. Well, you may discover that Johnson & Johnson gives $1 million a year to women's hotline for abuse. Is it significant to defining what Johnson & Johnson's corporate self is? No, it isn't. It's a great thing they're doing, but it's not how they run their business. So these 3 things guided us, and then we had to start removing some of the barriers, and for that we started publishing books. First came Investing for Good. Ethical investing had been a how-to. Investing for Good was a why-to. Then came the Social Investment Almanac. That was addressing the fiduciary. That was saying it's legal to. We had 51 contributing authors on how to do it, why to do it, and what made it legal, and all sort of a more academic tone to the whole thing. Eventually, I published Socially Responsible Investing. That was later on, but it was translated into Korean and Japanese and Chinese, which earlier books had not been, and indicated that the interest in the field had grown quite a bit to these other kinds of markets. Now, the commitment at KLD to remove the barriers and our buy-in to the concept that you needed to have a global network, like-minded, moving toward the same goals: ecological sustainability, universal human dignity, led us to explicitly reach out to people who might want to do research overseas and to share our methodologies with them. And Steve Leidenberg spent a great deal of time on the road, moving together with a group of entities that might become an international approach. We had in the U.S. Superfund site data that the government provided, which told us who was a terrible polluter. Another country would not have Superfund site data. So within each national set of constraints, how do you build the stakeholder model so as to give the investor an informed set of data about the opportunity set? The travels brought us to people like John Elkington at Sustainability, and Michael Jancy in Sustainalytics, Mitsui Tsukushi at The Good Banker, and Tessa Tennant, of course, who went on to create a whole Asian-based network in Hong Kong. These people all began building a body of work around these concepts of information that's ascertainable, significant, and can be answered with a yes, no, or a number question. So we had a global initiative going. Well, now I think you might be saying, what about that third question? Is it the right way to do it? Does it make any difference in the world? I may be a little bit of a Pollyanna on this, but I noticed right away, because I had all these licenses to sell products, so I knew from my learning that there was a Securities Exchange Commission in the United States, and that this commission had come about because we had a Great Depression and a stock market crash that launched the Great Depression. And that prior to the development of the Securities Exchange Commission as a regulator, companies would talk about earnings, but actually there was no standard for what earnings meant. And companies would talk about sales and opportunities and profit margins, but there were no standards for it, and really no reason not to lie. This regulator came into place and put into to being a set of reporting as to the income of the company, being the flow through the year, the balance sheet of the company being the snapshot of the situation at that moment in time, and the changes in financial condition with a series of footnotes and with somebody monitoring it, the auditing firm. There was going to be an independent board of director, and independent was defined, corporate roles were defined, and now here we are 90 years later, and those things that the SEC demanded reporting on in 1932 and 34 are now the purpose of corporations. They now dominate every report you get from a company, has followed through on those earnings and that definition to the exclusion of a great many other things. And in the United States, the Freshfield survey in 2005 of global legal environments found the U.S. to be the least likely to have a fiduciary obligation to invest with people on the planet in mind. And the reason largely was that we had increasingly crept toward this godlike figure, the investor, and making the profit, and that was the purpose of the company, to make the profit for the investor, full stop. Maybe to employ people when they felt like doing a public relations push. Now, if we could have that kind of reporting on the kinds of issues that globally we identified to understand better the corporate impact on stakeholders in that company, we will have in 90 years companies for the purpose of creating better impact on people and the planet. This is my naive hope there. But in the meanwhile, we do have some specifics to give us a little bit of a shot in the arm as we get there. 20 years ago, I wrote that the International Organization of Securities Commissions, IOSCO, was meeting, and that the agenda for the meeting was entirely dominated by hedge fund managers, which I was very mad about. I felt that the hedge fund, they can have environmental and social goals, but in that era, they certainly did not. And they were highly disruptive to markets. So why on earth would IOSCO be giving them the time of day and not giving me the time of day, and my arguments, my interests, the time of day? It was 20 years ago. Last year, IOSCO conducted a survey of regulators and exchanges and found that 38% of the global regulators want to clarify what constitutes sustainable investments. U.S. futures trading created the climate-related risk. French financial markets, and I have to read these things, established Climate and Sustainability Finance Committee, Canadian Securities Administrators Staff Notice, Federal Financial Supervisory Authority, BaFin, Guidance on Dealing with Sustainability Risks, Spanish, Monetary Authority in Singapore, French, Malaysia, Hong Kong, all in the past 12 months have put through new regulations on how to get better reporting, more trustworthy reporting on the kinds of issues that we're here talking about today. Would these regulators be acting this way had it not been for our field? Had it not been for the enthusiasm of small investors who flocked into the mutual funds over the last 20 years and built up a there so that now the kind of floodgates we're seeing, $50 billion last quarter into U.S. mutual funds in this field, have opened? I don't think so. We have nearly 50,000 European Union companies will be filing sustainability data under the new reporting rules. We have net zero finance initiatives, 160 investors, $70 trillion in investing. KPMG survey last year found 96% of the 250 largest companies report on sustainability. And these reports, we act as though they're all greenwashing, but some of them go on for 140 pages and have real data in them. They're not all greenwashing. And 90% of S&P companies, sustainability. Would these reports have happened if there were not investors asking for this? If the investor had no role in this process? 21 stock exchanges have sustainability stock standards for listing on their exchanges. Would they? 40% of companies worldwide acknowledge financial risk of climate change. 35, here this is a cute one. 35 states in the USA allowed benefit corporations, especially where you can actually in your corporate documents state that you are there for purposes beyond the investor. You're also there for the benefit of other stakeholders. And that's a particularly interesting one to me. That Domini 400 social index had a methodology that included 250 S&P companies, 100 companies selected to balance the industry problems that first step had put in place, and 50 companies that represented what the classic responsible investor was looking for. And in those days, we were stuck going to ice cream companies. Ben and Jerry's, great company. Now, Domini's got a sustainable solutions fund, and we have a great many choices of companies whose DNA is to make the world a better place. They were kind of created to make a product that would make the world a better place in some little niche. It's exploded in a virtuous cycle because investors wanted this kind of thing, and some wanted something a little better than just the S&P watered down. There was money available for venture that became a real company on the stock exchange, that became something that we could purchase, that put the pressure on us to make us ever cleaner, and then gave the impetus for the creation of these new companies. So the cycle keeps moving. And finally, I think it's just worth sharing that we have a situation in the U.S. where we have apparently got the full attention of whoever occupies the White House. For good or for bad, depending on whoever occupies the White House. But currently, a great deal of favorable attention is coming to our field to see how it can be enabled and how it can be helped. This has not gone unnoticed by our states that are dominated by the other party. So as recently as earlier this week, Texas is moving legislation through their state to bar financial services companies from doing business in Texas if they also have oil-free funds. So you can't make it up. So no, you're known by your enemies. And we certainly have some focus on us now. So I feel as though I'm moving toward being able to prove point number 3. I'm going to stop right there and let you guide me a little bit on the rest. I know that was a long time.
That was excellent. Thank you so much for sharing the history because a lot of people, are kind of newbies or they just started in this space a while. You came at it from a very values-driven perspective. You were not saying, well, let's see if I can squeeze out more fees out of this doing. That was not your driver. You came at it from very values-driven, from values around the environment and also social justice. So with all of the claims of the SIFs around the world of 30 or 40 trillion dollars going into ESG, if true, why is the list of problems bigger than ever, from climate, carbon, soil depletion, water, food? So is the present way that ESG is done just is it a death march in the wrong direction, but we're going slower? Or are the figures skewed? Unmute your mic. Yeah, it's okay. You can leave your mic on.
All righty. Thank you. Yeah, it's an extremely discouraging world at the moment, and some of our challenges are enormous. But here's the way I think about it: how are you going to, you could just say, okay, we're all going to die, or you could say, well, how would, if I were emperor of everyone, how would I make it right? I'd need something that reached everyone. I'd need something that had a coordination. Think about finance. Think about financial services. You have a globally coordinated, they speak to each other. They read each other's output all the time. They don't even know why something's happening, but their computer recognizes something's happening and they move to make corrective actions on it. It is roughly, and I haven't found anybody else who's tried to study it, but from what I can see, if you count stock exchanges, bond exchanges, commodity exchanges, the published options exchanges, the published insurance exchanges, you get to a point where it's very easy to find that finance trades at least 11 times more volume every day than purchasing goods and services trades. Mm-hmm. Global GDP is less than 10% as large as financial markets are. Mm-hmm. So who's stronger here? Real trade or money trade? You have a car, a Tesla, drive into a barrier on a highway, and some short seller in Malaysia, 40 seconds later, bang, they're out of it. It's amazingly powerful tool. How can we ever allow this tool to be only about rewarding investors? It's a whole lot easier to reward investors if you have slaves. It's a whole lot easier to reward investors if you throw out your trash in your neighbor's yard. You rob from the commons. People have called investing an extractive industry. You cannot allow that powerful a tool operating at that scale to be operating without a vision for a sustainable planet and a life worth living. You must create demand within that industry. I used to talk about infiltrating the beast and perverting it for good. I one time had the terrific opportunity to be a moderator for George Soros. George Soros, I figured, was an extremely sophisticated person. So I asked my question first as the moderator. And by that point, he knew what my field was. And I said, you know what my field is? How much do I need? What proportion of the financial industry do I need to accomplish the goal of using finance to be part of the solution? And he thought about it and he said, well, 15%. So that's been my goal. His off-the-cuff remark has been my goal ever since. And you did ask if these figures are real, and I think there is some question to that. The new approach that Europe has been putting together to identify what makes it real as basically having the three components of setting standards to what you purchase, engaging actively, including voting your proxies consistent with what you are using for standards for what you purchase, and direct engagement with the grassroots so as to foster new ideas and new businesses. This is, I think, a fair approach to take to the entire field. And the firms that do those three things are a good deal less than the headline numbers you're seeing as to how many social investors there are. Once that changes, and I think by making it explicit that this is the definition of the field, once that changes, it will lead to a lot more rapid behavior change.
Most of the world is not on the stock market. Most people don't get their money from IPOs. The value from IPOs is quite small, totally. The secondary market is big, but the primary, and a lot of large corporates, multinationals, have what we would call maybe stranded assets, which kind of prevent them from going a technology that might be a little bit more environmental benign or positive. Yet it's very challenging for retail investors to invest in, let's say, the private sector, the private equity markets. But do you really believe that shifting assets out of BP and Shell and maybe into Unilever is really moving the needle? Shouldn't the focus be more in the companies that are not listed, who are actually more innovative and don't have stranded assets, if we want to create an economy based upon well-being?
Yeah, my approach has always been go where the money is. So, if you get a conversation with McDonald's to adopt standards for how they source their fish for the fish fillet,
okay,
you've made a great deal more difference in the world than if you finance 200 windmills. Now, the point isn't that I think it's better or not better. I feel very strongly that you need all three things. You need to keep watering the grassroots, and you need to set standards, and you need to engage. And the whole system, we used to call it a three-legged stool. These were the three pillars the Social Investment Forum started on, those many years ago, 1984. So the three-legged stool doesn't stand with only two legs or one. You need all three to stabilize the situation. And I am a believer that you need all three things. But what's so exciting about this new business generation thing is it has created a kind of a demand that is creating a kind of an answer. I don't think it's perfect yet, but we have these new special purpose corporations here in the United States, SPAC. They've come to be a little bit, controversial, but basically I go out, I raise $2 billion. I say I'm going to spend it on organic farming somehow. And I look around for a venture opportunity to spend it on. And by purchasing that venture opportunity, they become a public company, my SPAC. So you, the investor, are investing in my dream, not even a real business when you buy it. This has got a lot of negatives but I think we can deal with that, and we can make this a vehicle that will democratize this, what you referred to before, the difficulty of investing in venture capital. It's still a little bit bumpy on the start, but what it has meant is that companies have been able to get through to the public in very short order without the kind of onerous give-ups that conventional venture capital imposed upon them. Here in the U.S., we had a company, App Harvest. It's a benefit corporation. It's got its purpose. It's organic, basically tomatoes, vine plants in greenhouses in Kentucky, where there used to be nothing but coal mines. So there's a big unemployment issue in Kentucky. It's a terrifically central location, so these tomatoes can be sent around the world. It checked a lot of boxes for responsible investors. It checked a lot of boxes for what investors who wanted to make a better food chain happen with their investment dollars directly, the kind of investor you were just referring to. And it was all brought together because of a vehicle that didn't exist 5 years ago. And as I say, I don't think it's perfect yet, but I think these vehicles thinking this way will allow a good deal more of that opportunity set for the investor. It's always been difficult for me to justify, most investors really can't evaluate whether or not that company is going to make it. So I like having some sort of intermediary that does the evaluation. We'll see whether this is the right one.
Beata, I'm going to start taking some of the questions because there's quite a lot. I don't know if we'll get through them all. Beata wanted to know, can you give us the good, bad, and ugly of today? Where are the hopes and where are the biggest disappointments?
Ooh. How much time do you have? Well, let me say, I'm going to interpret this as being within my field.
Sure. Okay.
Rather than, the whole thing. The good is there is an explosion. It's extraordinary. Every firm has to have their ESG product now. And it is something that they're gearing up for and they're trying to do well. We had, I don't know, a small asset manager, hedge fund, small in the world of hedge funds, asset managers start a impact investing product. The first thing they did, they go out and hire 5 people. The 5 people for their impact research were good people. They were good hires. They had the money and they got the best. They run it, and this is repeating itself over and over again. We have the corporate social responsibility officers beginning to be developed in all of the corporations. You look at Amazon, big company, big problems. They decide they need a social responsibility department. They created 50 people. And one of them was my former head of research. Good person, right people do it. So the good is that this is really beginning to develop and is developing in a very professional way. The bad, I would say, is that it's always the same, isn't it? The person in charge is a little the weak link. So while the staff knows what needs to be done, the corner office is a little slow on picking up on it. And they're making rookie errors like, BlackRock writing editorials about climate change risk and how all investing is going to be done this way, and then voting against climate change resolutions. Mm-hmm. Yeah. I mean, just a rookie error. But they'll learn and they'll begin to move forward in this process. So, I'm extremely enthusiastic about it. The dark side is that you do have the greed factor ever bigger, and the wealth and income gap is going to be something that a few very wealthy people will have too much control to wrest it away from them if we don't deal with it very, very quickly. And there are no rules. I mean, we've been sitting here, on this planet for a couple million years waiting for God Almighty to come down and make it not happen. It happens. We've seen it happen repeatedly through life. So we do need to address the ugly side of fast or slow wealth building that allows for these extremes and dynasties and entitlements and things. I've forgotten the third part, so I won't answer it.
Okay. Susan wanted to know, very glad that you mentioned corporations answering questions with figures or yes or no. What are the most, powerful tool or metrics we can use today to promote sustainable investing?
Well, at the end of the day, the performance is always a very, very strong tool. During the period that we were studying the Domini 400 Social Index, one thing that I came to believe quite strongly was it rooted in the ESG research, and that is that you have, I'll put it in simple terms, you have Company A and Company B, they're in the same industry. Company A has 5 product safety recalls, Company B doesn't. Company A has a non-diverse board of directors and a non-diverse management team. Company B has diversity of gender and ethnicity on both places. Company A has 3 times run into class action lawsuit problems with employees. Company B hasn't. Company B has a couple of third-party awards for their corporate responsibility behavior, one in being a great place to work and another one in their climate change. Company B reports to the carbon disclosure product in a manner that is clear and legible and useful, and Company A is a little less so. What has emerged out of this information? 1, you want to be in Company B, not Company A. And 2, who's in charge of Company B asleep at the switch, failing on point after point after point after point. And this is the single toughest thing for active investors to judge. Quality management teams. And we have developed through this methodology of looking at hard cold facts a means of judging the quality of management and of biasing a universe of stock that we're buying, in that case an index, to higher quality management teams. So as people start to understand that this method of investing is introducing a very positive bias to your outcomes, not in every market. When U.S. decides that we're going to invade Afghanistan, the only stocks that went up were oil and weapons. We didn't do well. There are going to be markets where our field doesn't do well. But by and large, over time, high-quality management teams outperform low-quality management teams.
Okay. Derek wanted to know, could you share with us 3 key moments or encounters of your career? It could be 2, maybe there are more, I don't know, that you are willing to share.
I tend to look at networks when you ask that question. So early on, I was invited to speak on a stage, and Tim Smith, then executive director of Interfaith Center on Corporate Responsibility, was discussing the struggle in South Africa, and he had Ford Motor Company on its knees, and he was negotiating this and negotiating. And I thought, oh, thank God, I don't have to follow Tim Smith. And then Chuck Mathai stood up. Chuck's been dead 30 years now, so people may not know him. He died very young of a cancer. Terrible. He was the Johnny Appleseed of community lending, community financial institutions. He stood up and he said, well, I'd like to change the focus of this conversation from big global events to Marie. Marie lives in Cincinnati with her 11 dependents in a 3-room apartment in abject poverty. And I thought to myself, oh my God, this is the person I have to follow. But I came away feeling I need those 2 people. I need the power of what they bring to the table to have my conversation. And it really was the start of this 3-legged stool concept of what this field was. So that is one thing I would call a very strong. Maybe a second time I might say I was at an Interfaith Center on Corporate Responsibility meeting when somebody that you invited to speak at this very forum recently, Father Seamus Finn, approached me. He said, you like baseball? Well, sure. I'm an American, aren't I? I like baseball. and he said, what do you think of this baseball? And he had a baseball. I said, well, it looks remarkably like a baseball. I didn't know where he was going with this. He said, this baseball was made by Figge International in horrible conditions in Haiti. My brothers, the Oblates, are down in Haiti, and they've been to the factory where this baseball was made. Something has to be done about this. Because Figge International does not employ those people. They buy that baseball from a third party. Okay, well, sweatshops were born. He really led the charge on a discussion about supplier chains and the conditions under which, and changed the dialogue so that a Figge International, which no longer exists, or a McDonald's or a Disney can no longer have their little toys or whatever, made under horrific conditions and say, got nothing to do with us. But it started from this little, my brothers have been to that factory. We've got to do something about it. And it resonated with the South Africa conversation that, we know the facts. Maybe I could just share one other story that's almost the same as that one, but kind of nice. I in a dialogue with Intel, meeting with the Intel team, did what all people who have dialogues with them. We were concerned about a factory in Albuquerque and wanted to know what kind of chemicals they had in that factory and wanted them to report on it, at least annually. They didn't want to, and they thought it would be illegal. Way too difficult. Very, very expensive. And they're not sure that it was something that could be disclosed. Like all people having dialogue, we had brought in an activist, because that's our role. We're not going to know a field. We're going to bring in somebody who does. So we brought in an actual grassroots person from an NGO who knew something about the problem. And he sat there and listened for 20 minutes to the problems and all of this. And then he leaned forward and he said, so you're telling me you're breaking the law? And the guy from Intel said, no, I'm telling you what our problems are. And this guy leaned forward and he said, Albuquerque regulations require you to tell the fire department every quarter this information. You have it. We're asking you to share it with investors. And the entire conversation fell off. It just changed and the reporting happened. So, they say that about a court of law. Lawyers shouldn't ask a question they don't know the answer to. and it was a good lesson in that one. So.
Hazel Henderson had a question. We still push for financial transaction taxes and a global minimum tax for all corporations. Yeah. What do you think, Amy?
Yeah, time. It's time. Hi, here's another great Hazel Henderson. Thanks for joining us today. She's been a long time somebody to admire and live up to. But there is an increasing role that, at least in the United States, responsible investors are playing in policy and in attempting to get policies enacted that will enable our field and will slow the break speed of financial transactions to something where you have a little bit more of an investor and a little bit less of a gambler moving the stock prices. We at Domini Impact Investments were early in one of these initiatives. We did write to the Securities Exchange Commission under Harvey Pitt, so going back a while, asking them why it was that mutual funds did not have to disclose how they voted their proxies when other investors do, asset managers do. And stating that we thought mutual funds, as the fastest growing owner of assets in America, should also disclose this. This went out for a study. It was prior to the internet, not prior to it, but it was early on. And the SEC had never had so many comments on any issue. And they did, in fact, mandate that mutual funds disclose how they voted their proxies, which is how we know that BlackRock did not support climate change. Disappointment, rookie mistake. So we as an industry also have increasingly attempted to protect our field through policy changes.
We're going over time into the networking session. I don't mind taking more questions. I just wanted to check with you how because you've been very generous in allocating the full 2 hours for this. So I can take a few more questions, or we can switch to the virtual networking where people are connected. What would you prefer, Amy?
What I would prefer now, you guide me.
All right. I'm going to take one more question, and then we'll switch to the to our networking. Jürgen had a question. He had a meeting with the German impact investors last week, and he was asking the question, what are your true impacts to the world? What are your targets, and are they quantifiable? How would you respond to Jürgen's question?
Well, this is what I was attempting to get at a little bit here is that it's a very long game. We want my long-term goal is to have investors be part of the solution. And the way that we will get there is going to be by creating these standards and using them for the investment process, which mandates research, which mandates corporations start thinking about things and how they report it. It can all be done. There is somewhere in a big pharmaceutical company, some expert that knows precisely to the penny what it's worth for a patient to walk 200 yards with a smile on their face rather than wincing in pain. They have an absolute price tag on something that we call non-monetary. And you walk into an apartment building and you have an unobstructed view of the sunset. That broker selling that apartment knows exactly what that unobstructed view is worth. So we have to become better at creating monetary valuations on some things that we have not created monetary valuations for. And that will inform the total conversation about what kind of a good we're having. But in the meanwhile, the kinds of things that I was listing before that are, let's say, for example, you have in South Africa a stock exchange that mandates and rewards disclosure on these kinds of issues. What happens at the corporate boardroom at that time? Somebody's saying, well, we've got to file this report. How's the report coming? And they're reviewing the report, and they're looking at the data that the report has, and they're saying, oh, geez, 5 more industrial accidents this year versus last year. That's not good. How'd that happen? And they're grilling management on this thing happen. This is repeating itself over and over and over again every time you have a new company creating an environmental, social, and governance kind of reporting system or full reporting system. And that's a benefit that just didn't exist until investors got involved with it. Now, a lot of what people answer this question that's been asked with is they'll turn to the community development and say, look at all those jobs, look at all those, and that's another thing that my field did. We had a loan. You make a loan to a nonprofit in America. If you make a loan to a friend, you have to pay interest on that loan even if you didn't get it. If you make a loan to a nonprofit, you don't have to pay tax on the interest of that loan, even if you didn't get it. If you make it to a nonprofit, you don't have to pay tax on that interest. That was a change in the tax code that my industry got way back in the 1980s in order to make community loan funds better, more attractive. Now, in the U.S. government, our community development financial institution legislation is extremely robust and we started with $25 million in the first year of budget. We're moving up above $6 billion this year in the budget for it. So it's extremely, you have to first plant the seed, and then how many jobs. When you're in a community, somebody on this call probably has better, but in a typical way that you think about community lending is that you're looking for the bang for the buck that is going to be that for, the dollar you put in is going to return to the organization within a 3-year period, and the standard of living of the 4 people in that household is going to double over that 4-year period. And you do the math, and pretty soon, why would you spend money any other way? Because you have such a multiplier effect in community lending. There are studies that come up with those numbers and could be an answer to the question. And finally, there's the direct dialogue with these corporations. As I said before, I mentioned the fish at McDonald's. That story came about because Greenpeace published that the Alaska legislature was going to open up a new area of fishing, which was particularly deep and where the mother fish that have, many, many more eggs than the younger fish have sink to the bottom. And now they were all going to be fished out. And that Greenpeace was upset about it. Our on-staff activist, you don't have on-staff activists at conventional investment houses, had a relationship with McDonald's, called them up and said, is this true? Are you going to be buying fish that are killing the fish? And on a dime, McDonald's notified the Alaska state legislature that that they were doing that, but they wouldn't be buying any fish from them anymore if they did it, and changed the whole thing. You don't get there if you haven't done the 10 years of history beforehand, if you haven't built the relationships and built the credibility and built the we're in it together side of it with the activists. And you don't get there if you don't have an activist.
The financial sector are hunters. They're incentivized for short-term behavior. And you're asking to teach farming to hunters, which it's not always that easy, but you've been doing it a very long time. You have now wind in your sails. The world is going in this direction. I don't know too many financial investors saying, I'm looking to find ways to pollute more, waste more. People in one way or another are looking to use money effectively. They don't always find what they're looking for. But it was a long road that you were traveling, which at that time, I'm not sure if you even thought that we would get to these levels of interest. So how do you teach farming to hunters?
It's going to go back to and I've said it before, it's going to go back to the performance. And the performance has an edge because we're identifying better, more on-the-ball management teams. It's also going to have an edge, certainly during this past year, COVID and U.S. markets, we had a tremendous edge. The system was under extreme stress, and that led to solution-oriented companies seeing their need, the need for their services, move through their 10-year plan in 6 months. So you have a company that has a way of monitoring whether or not you have irregular heartbeat. And you don't have to be hooked up to a hospital bed for 24 hours to do it. They hoped over 10 years they would get reimbursement from our financial system, from our federal system for doing this, for having this device that you could walk around with. But it happened in 6 months because nobody wanted to waste hospital beds on this need. Diabetes treatment, online education, video conferencing. It was a nice gimmick. It became an essential need. The stocks of the companies offering these video systems soared on this news. The climate change is creating the kind of pressures that we have fires going on in California all the time. What's one of our hottest stocks? The company that makes the generators, because nobody wants to count on the electric grid anymore. It let them down in Houston, Texas. It let them down throughout all of California. The grid's falling apart in this country. So these kinds of pressures from man-made, in the case of climate change, from our own poor behavior, are building the need ever more for the kinds of companies that social investors essentially seek out. That leads to better performance. And that, I think, is what removes the barriers in the final analysis.
You probably don't have, or maybe you do, you don't have many conversations about why anymore, or as many as you had before, probably more about how. But correct me if I'm wrong. I still look out. I like the Donald Trump types. I like them. I like working with the irresponsible investor and criminal types because they're very predictable. It's not that hard to. I never really found it hard to convince them that the challenge was always access. The more money someone had, the more isolated they were. So, do you find the tone of the conversation is dramatically different from let's say 10 years ago, 5 years ago?
We did have a little conversation earlier about there's a learning process each time somebody starts into a new field, and as it's generally speaking at the corner office. And so the tone from the corner office is pretty similar to the tone from the corner office several years ago. When I launched the first mutual fund, I didn't want to launch a mutual fund. I wanted Fidelity to have my idea and run with it. I wanted Bear Stearns, which was a company then, to have my idea. And I got through. I had the marketing, the acquisition person very excited at Fidelity, at Vanguard, at all of the big mutual fund companies. And then it would go up to executive and get rejected. That tone there has not changed very much. And I think that there is just a kind of a bias. People who become successful think that what they actually did is the right way to become successful, instead of saying what their personality traits were was helpful. And if they could just think about rather than the actions they took, sort of why they took those actions, they'd probably pick up on some of these subtleties a little faster. I'm sorry that you're so admiring of Donald Trump.
Well, not admiring. I like the type of person, because I often was sitting next to people like that, and I was trying to convince them about sustainable investment, and they would, be very against anything. But in the end, I always found them very easy to convince. I never really found it very, difficult, because they're so predictable. They never kind of really surprised me. What can this audience do to help you? Because we have a lot,
Get out there and do it. Get out there and do it. Advocate, write the book. I mean, I can't, I wish I could live forever, but it's time for another generation to move ahead and start identifying the barriers and removing them. And it's remarkable. You can, but in fact, you can. And if that barrier is legislative, then get involved in how to change the legislation. And if it's that people just don't understand something, try to explain it to them differently in writing, preferably. Podcasts, maybe. But, the written word is nice because it can pop up again in 15, 20 years and, just sitting on somebody's bookcase. So, but anyway, do it your own way, but do it. That would be my goal.
I'm going to wrap. I'd like to take a group selfie, if that's okay with everybody. So I'm just going to set this up, group please. All you have to do is look at the camera and just take a photo, and then it'll make a collage of everyone who's in the room if you want to join, and then we'll go right into the networking, or the virtual happy hour, the mixer, whatever you want to call it. Amy, it's been actually a joy. You hardly anyone left the room in the whole time. That's the first time that ever happened. So everybody was glued to the screen to listen to you. You've been fantastic. I want to also thank our entire production crew for making this work. Sam, our producer, crypto genius, and ramen critic, Ricky, my absolute better half with no filter, Xi Jinping, our head of transparency and integrity, the Myanmar generals, our power-sharing advisors, Vladimir Putin, our head of conflict resolution, Jeff Bezos, our human resource and full-text compliance leader, Ted Cruz, our sedition expert and humility mentor, Marjorie Taylor Greene, our astronomer specializing in Jewish lasers, and Elon Musk, our humility coach. I want to thank all of them who helped make this show, and particularly Amy. For those of you who want to network, just exit here. I put the link directly that you can go to that room. I also added a link. Hong Kong is looking to revamp its regulation regarding listings, so they want input from all of you geniuses. So if you click on that link, you'll be able to give comment. I'll make sure that everyone gets a link to the replay. We'll send it out in a couple of hours. So thank you again. Just exit and go to the virtual networking, and the system will connect you with someone for a 5-minute video chat. And if you're lucky, you'll get to speak to Amy. Amy, thank you so much.
Thank you. It's been great.
Okay. Great. This rendering photo.
Appeared already.
Okay, so all you need to do is just click on that link to go in the other room.
Yeah, but the comments have already piled up, making it off the screen.
Yeah, well, that's okay. I can send you the list of all of the comments and the questions that we missed if you want that. That's not a problem.
No, but I'm saying I can't find your link because it's already down below.
Oh, I see. Okay, so what you do is, let me add it.
I can go up. Okay.
Here, I'll edit again.
I was assuming it was going the other direction. So
No
I got
problem.
I'm
I'll
in.
put it up here. Okay, there you go.
Yeah, bye-bye.
Bye-bye. Stop streaming.